with you in just a bit from now. PVR Inox reported numbers early on for the fourth quarter and for the full year number as well. The numbers seem much better, of course, as compared to the previous year. Revenues have gone up about 11% year on year to about 1,290 crores. That's, of course, for the quarter. We are now joined by Mr. Ajay Bijli, Managing Director of the company. We'll also have the CFO join us in just a bit. Ajay, good afternoon. Good to have you back with us here on CNBC-TV18. Prashant this side. We spoke to you just a few days back, and at that point, of course, you could not talk about the quarterly results or anything financial. So let's start there. So you've you're in the black in 24. Will this continue? I mean, would you? How is FY25 looking? If you can guide the market and us as well for what trends we should expect.
Well, what I'm happy about is that 2 years it's been since COVID. Things are only improving. We had 140 million people who came to us last year, and this year we got 150 million people. So that's good. Occupancies have gone up slightly, but our revenues are up by 17%. I'm talking about the full year. And also our EBITDA, we've still come out with 809 crores of EBITDA. So things are only going better. I think the three fraternities which define our business. One is the film fraternity, then the real estate developers. We're joined at the hip with all shopping centers and malls. And the third is really the consumer. They're all, getting their act together after being shut for so long. And so slowly it's all inching towards positivity. So, I mean, the outlook every year, these are movies which are on paper. But currently, at least, I'm excited about some of the South films which are coming. Pushpa 2 is coming, Kalki is coming, Indian 2 is coming. Some big films are coming. In India, Hindi films, the genre which is doing exceedingly well just now is, with the youngsters at least, is these little jumpy movies and little scary movies. Hopefully the numbers won't be scary. So Stree 2 is coming, Bhool Bhulaiya 2 is coming. Amir Khan is coming after a long time with a movie in December. A big movie of Amir and Sunny Deol coming together is coming, called Lahore 47. Then you got Baby John, which is a South Indian, another Atlee movie with Varun Dhawan. So at least the lineup, which is the film part of the whole thing, is looking promising. And as I said, consumer has also now given its verdict then that they want to go out and entertain themselves, which is the reason why we've got 151 million people who came to our cinemas last year.
Gentlemen, afternoon. This is Reema here. Nitin, your average ticket price has declined in Q4. So what led to that? And you've typically said in the past that the company takes an annual price hike of 4 to 6%. Is that on the cards? And if yes, when? And particularly about footfalls and occupancy in the near term, in the quarter that we are in. Given IPL is going on, should we expect a drop in footfall occupancy? What has it been so far in the quarter that we're in?
Sure. Our ticket price is directly a function of what films we are getting during the course of the quarter. In Q4, you would have noticed our footfalls were slightly lower than how the Q2 and Q3 played out. So because they were not very big films, our average ticket price growth was, negative during the quarter. We still maintain our guidance to, get to inflation-led growth 3 to 4%. But, during the course of last financial year, we had ticket price growth of almost 10% because of the merger synergies that the way they have played out. I think this year, ticket price growth is going to be slightly lower. We are completely focused on, getting more people to cinemas, including, launching initiatives like Passport, which is, a subscription service where at 349 rupees a month, you can watch 4 films during the weekdays. So we'll be launching more of that. And, we are going to look at a slower ticket price growth this year, but the focus will be to drive more admissions. The second question.
So, Nitin. Yeah, go ahead on occupancy and footfalls, given that IPL season is on.
Yeah, I think quarter one is going to be a slower quarter because a lot of film releases have got pushed out, not just because of IPL, but because of the elections, because you have to close down in most of the markets during the course of elections. So I think April and May are quite slow months. We expect, film releases to pick up starting mid-June onwards. And hopefully Q2 and Q3 will be great quarters where all the big films are lined up for release. But Q1 will be a slow quarter, given what we've seen in the first 45 days of this quarter.
Nitin, hi, afternoon. So give us a slightly longer horizon view, because this is also the first interview as we're talking to you in FY25. Now, a lot of things are happening. I mean, there's a premiumization, and we remember our conversation with Ajay just a few days ago, where your premium screens are 15%. Gradually, I think the plan is to take them to 20%. That's one aspect. Then the way you're sort of moving with the average ticket price, coupled with the way the trends you're observing on the F&B side. So all things put together, you closed FY24, I think, at an EBITDA margin of around 13%. Now that the business is back, sustained, run rate for EBITDA margins, what should shareholders expect? I'm talking about yearly EBITDA margins.
Yeah, see, ultimately, as the business matures and stabilizes, we want to get back to 20% kind of EBITDA margins for sure. A part of it is also a function of how the content lineup flows out, during the course of the year. But if you look at our investor presentation, we have done a lot of work on the cost side. And, we are waiting for, a box office to start performing slightly better, because our advertising revenue, uptake is going to play out in the next 12-15 months as the box office picks up. So we expect to go back to 20% EBITDA margins in a midterm. It's very difficult to say whether it will happen this year, but we're definitely in the 12 to 24 month horizon. That's the aim, that we want to get back to pre-COVID level of EBITDA margins.
4 months is the target for that 20% margin. Is that the right way to look at it?
That's the right way to look at it. Yeah.
Got it.
And Nitin, that in your investor presentation, there is this fascinating sort of table, FY20 to FY24, how have costs moved, right? And you've kind of, you looked at for each of the items, rent and manpower costs and utilities, how you've, to increase margins from here, I'm assuming this is that you've squeezed out everything you can, right? Or help could come from the cost front as well. That's still possible.
I think the big cost now we are focusing on is the occupancy cost, which is the rent and CAM that we pay in shopping centers. Whatever was directly within company's control, you would notice that we've done a lot to squeeze out, cost savings during the last 3 to 4 years. But we are also working equally hard to drive up revenues, because getting more people to cinemas, through various pricing initiatives, as well as a lot of promotional initiatives, remains the key target of the business.
So you'll also have plans to liquidate your real estate assets, and you're sitting on prime real estate, whether it's in Mumbai, Pune, Vadodara, and I think it's valued at about 300 to 400 crore. So first correct that, and if that's the right number, the valuation of your real estate, and what's your debt deleveraging plan? How much will you pare down in FY25? How much in FY26?
Yeah, so I think the plan is, if you look at even in a volatile year that we had almost 100 crores of free cash flow that we generated from the business. And all of that has gone down to pay down debt. During the next 12 months, whatever will be the free cash flow that will get generated out of the business will be used after CapEx to fully prepay the debt. And, we're in the process of figuring out the monetization of real estate assets. We are in that phase where we're evaluating the sale. And all the money realized from, monetization of that assets will be used to pay down debt. Our focus will be, to reduce our leverage down by at least 50% over the next 12 to 15 months period.
Okay. All right. So looking at reducing leverage. Ajay, finally, a little short on time, but we want to sort of end with a couple of strategy notes from you for the year ahead. One, Prashant was just pointing out, I think, from your presentation that you've tied up with the Devyani International for, certain F&B initiatives that you're looking at. So just explain that rationale. And also, I believe that a large chunk of the new screen additions are going to be happening in the south. So why the stress in the southern markets, and just, larger strategy to grow the business as this year rolls out?
Which is a couple of things. One is Devyani, definitely, because all our F&B sales just now are post-ticketed, and we believe F&B is a very important driver for our business. And again, not putting all your eggs in one basket. Some pre-ticketed F&B income is something that we've been very focused on. And we had either the choice to do it ourselves or tie up with somebody like Devyani. We already have a relationship with them because of our Pepsi association for a very long time and Costa Coffee relationship with them as well. And lots of malls have got these, so to speak, unorganized food courts, which are not branded. And we believe that if we tie up with Devyani already has a focus on food courts, but a lot of shopping centers offer this opportunity, and we can get more share of the consumer's wallet. 150 million people, as I said, come to our cinemas anyway. And we believe that's a good pivot for the company to do, rather than just focusing on F&B, which is post-ticketed. That's one. Second, South market always has fascinated us more because the content supply and demand is much more robust over there. You have Malayalam, Tamil, Telugu, Kannada and English, Hindi films which get consumed. And plus the movie-going index of southern customers is much more than north, east, west and south. But the fourth strategic pivot that we are taking is that our capital intensity is going to be lesser this year. We are going to be, we have a lot of deals in place where the developer is going to be contributing into an asset-light model for us. A lot of retail companies have moved into that, and we believe the brand is established now to move into that zone, which hotel companies do. And as I said, certain retail companies recently have started doing that, either a FOCO model, which is franchise-owned company operated, or pure, a very asset-light model, where bulk of the capex is done by the developer. So we are being very, very choosy about how we grow, because we've already got a base of 1,744 screens. So everything that we add now has to be value accretive. It has to be asset right.
All right, gentlemen, thanks a lot, Ajay, as well as Nitin, for joining in and giving us all those details. We wish you all well for the remainder of the coming fiscal, and just a request, go a little easy on the price hikes. Old timers like me love to visit, the cinema halls and enjoy a movie. All the best. We catch up in the coming quarter as well.
Thank you.
All right, well, time to get back to the